Hello and welcome. Thank you to everyone for sharing this time with us today. My name is Maria Smith, and I am the Chief Impact Officer here at BII. And we at BII have been investing in SMEs in our markets for decades. I personally haven't been involved for decades, but at least the last 15 years. And we certainly think that it's an important and a vital component of the economies that we operate in. Yet we see the funding gap. I mean, there's over $4 trillion that's needed in emerging markets in order to finance what's needed for the growth of SMEs. So I'm really thrilled today that we have our speakers that are quite diverse in experience. We're going to be talking about why SMEs matter, why this financing gap exists, and I think very excited that we have people from the markets that are actually spending their day-to-day operating with SMEs and can give us, I think, a real example and illustrations of what the challenges are. So to start, before we get to the panel discussion, we're going to have two speakers that are going to give an overview of recent papers that have been published. The first is Tim Doberman, who will start, and then our own Stephen Ayers, who will talk about how and why finance matters to SMEs. So to kick off, I'm going to give it to Tim. Over to you.
Great. Thank you, Maria, and great to be here with everybody. So I would like to start with the first slide, please, not the last slide. And I'd like to start by giving some of the highlights of a recent report that IGC has done in close collaboration with BII on the role of SMEs for development. Next slide, please. When we think about development, we should think about the movement of labor outside of subsistence jobs, so working in the home or on the farm, often unpaid, then moving into paid work, so home enterprises that might be selling a few products to local markets, shifting from that paid work to working for firms, so being employed for the first time, getting a salary, and then eventually finally arriving in specialized work, engage in diverse occupations that really draw on skills and pay higher wages. So you can characterize this process of moving from subsistence to kind of specialized work as the arc of development. And really three transitions might characterize this process. The first is that marketization of work, moving out of the home into the market, selling products for that first time. The second is this emergence of firms, being able to get jobs, working for firms throughout different sectors in the economy. And then lastly is that expansion within firms, so firms growing, expanding, investing, and becoming more productive. So where do SMEs fit in? SMEs really come in on those last two levels. So the expansion of the emergence of firms as well as the expansion of firms. Next slide, please. And what we do in this report is to try to get a sense of what does the existing research say about this process? How do SMEs impact these two transitions, drawing both from academic literature as well as insights from practitioners. And the overall conclusion is that there is a lot of value in SMEs in this process, but there's still a lot of things we need to find out. The evidence is quite mixed, and there's many things we need to learn. Next slide, please. So what I'll be doing is I'll be talking about three main areas of impact that we looked at in this report and through which SMEs are driving us along this arc of development. Next slide, please. The first heading is on productivity. Now, we find that large firms are more productive than SMEs on average. This is due to their specialization in certain areas of work, as well as their ability to get economies of scale. The key note there is on average. You might have highly productive SMEs, as well as relatively unproductive large firms. But on average, we see that large firms are slightly more productive. However, SMEs are still integral for the economy, as they contribute significantly to aggregate output. If you look at the graph on the right-hand side, this is showing the share of firms by the different sizes. And both in sub-Saharan Africa and South Asia, we see that the largest proportion of firms are these medium-sized firms, in this case defined between 50 to 300 employees. Now, one thing which has often been discussed is how do we get SMEs to become large firms? And the reason we discuss this is because there's a missing top empirically. What we mean by that is there's actually far too few large firms. Sometimes we talk about there being too few medium firms, but empirically actually there's much more evidence to say that there are fewer large firms. And so one of the key questions, which I'll touch on briefly, is how should we think about this process of moving SMEs to becoming larger firms? What does that entail? What are some of the constraints that need to be overcome? I should caveat this by saying that even though there's a missing top, it doesn't mean that there aren't significant constraints that are facing medium-sized enterprises. So for instance, in the credit market as well. Next slide, please. So the fourth kind of headline result on productivity is what I've been discussing, which is that large firms don't actually appear organically. They aren't growing from SMEs becoming large firms. They often just appear large in the first place. And this is maybe because you have large upfront investments by governments or foreign investors or other investors entering a space for the first time. But what that really tells us is we really need to learn much more about this transition, moving from SMEs to large firms. And that's a central question, not only, I think, for DFIs, but also for us in the research community as well. And then very lastly, so far, it seems like SMEs have had limited contributions to global value chains. It's a bit trickier to measure that, but at the same time, they could stand to benefit quite a lot from further integration into these global value chains. We definitely need more evidence in this area, and it's certainly something which we think is particularly promising in light of the opportunities in the digital economy. Next slide, please. The second area we looked at on impacts of SMEs was employment. So SMEs provide the majority of jobs in developing countries, around 70% according to our calculation. And these jobs are being created especially in the youngest of firms. If you look at the graph on the right, you can see again a very similar size distribution. This is showing the employment share by firm size. In both sub-Saharan Africa and in South Asia, roughly about 45% or so of employment is being taken place in medium-sized firms. Nuance, however, is quite important when thinking about the role of SMEs in employment. SMEs also are associated with higher rates of job destruction. So they may be creating jobs, but jobs are also being destroyed in the process. And really, this is because there's a lot of heterogeneity. And so we need to think about aspects which impact the SMEs' performance in the economy. That could be their age, their business dynamism, the sectors they work in, their managerial characteristics, etc. Lastly, although SMEs employ the majority of people in these economies, we do find that larger firms tend to pay higher wages and are often offering overall better jobs, defined broadly speaking in terms of compensation and benefits as well. So there's an important role for large firms here too. Next slide, please. This is just briefly to look at the relationship between younger firms and employment growth. So you have different firm size categories, micro, small, medium, large on the x-axis. And then within these, you have the age of the firm. So the youngest firms are in dark purple, the oldest firms are in pink. And if you're above 0 on this graph, you have an above average rate of employment growth compared to the average firm in that sector. And so we see across all these different firm sizes, the youngest firms, those in the dark purple, are having higher rates of employment growth than those who are much older. Next slide, please. The last area we looked at was inclusivity. Intuitively, we can imagine that disadvantaged or marginalized communities are more likely to find opportunities in SMEs compared to larger firms. There's certainly some evidence that the informal sector, or kind of firms that are operating in that gray zone between formal and informal, are helpful in achieving this type of inclusivity. But this is definitely an area where we have much more limited rigorous evidence on how much SMEs can promote inclusivity in terms of employment. What we do find, however, is that SMEs certainly are providing necessary goods and services to marginalize the remote groups. This is often because the largest firms find it difficult or uneconomic to cater to these areas that might not have a large enough market. But again, I'd say this is an area we need a bit more research. Next slide, please. So to summarize, SMEs are certainly integral to this process, this arc of development that I've discussed in the beginning. But we should really think about their nuanced and heterogeneous impacts. That will be extremely important for the interventions and the products that we come up with. And these products should be really tailored accordingly to these nuances. We don't have time to go into this today, but in the report we talk a little bit more about a different typology of SMEs, not just thinking about firm size, but adding in other characteristics such as firm age. We think that's very important ultimately for for examining this space. Next slide, please. So just to touch on in a few words, I think Stephen will cover this a bit more on that. One of the points I raised about how do we get small firms to become large. We certainly see that there are substantial barriers to growth for SMEs. Next slide, please. And these barriers are probably felt more strongly by SMEs compared to larger firms. We could call size-induced market failures, whether that's in access to credit, access to infrastructure. So on the map here, you see the share of firms that face electricity outages in a given period of time. It's very likely that SMEs have a harder time dealing with these outages compared to large firms. SMEs might also be less competitive in the market for talent and being able to attract skilled workers for their firm. And lastly, their management practices might not be as effective compared to others, and they might not know or have the information on how to improve their production processes. So all of these are constraints which likely hinder the ability of SMEs to grow and potentially hinder their ability to become large. Next slide, please. Next slide, please. So to close, we have 3 core recommendations on how to think about this space of SMEs and development, both for practitioners and researchers. The first recommendation is we need to consider heterogeneity very seriously. This is not only over how we define SMEs, but also about the characteristics that different SMEs have. Their age, their business dynamism, the sectors they work in, managerial practices, etc. Once we have this nuance in our minds, that will help us assess the relative impact that these SMEs might have on development. The second recommendation is we need to enhance data collection on these SMEs. To understand these nuances, to measure this heterogeneity, we need to collect nuanced and consistent and disaggregated data on SMEs. And then the last recommendation is with this data, we can then move towards tailoring products, tailoring interventions that really target these specific nuances and target these specific SMEs to try to achieve the most impact. Next slide, please. So thank you very much. This gives an overview of some of the main points in our report, and I think I'll hand over to Stephen, who will go into a bit more examples from BII's end. Thank you.
Right, good afternoon, everyone. As said, my name's Stephen Ayres. I work here at BI in the Development Impact Economics team. Really, I'm here to follow on from that really good presentation by Tim to talk a little bit about how we apply at BI some of the thinking and evidence around SMEs to this question of how and why we finance them. And in doing so, I'm going to be drawing upon a recent paper that we published in January of the same title. The next slide, please. So to begin with a quick thought experiment, here we have 4 firms of 4 different sizes, each of which produces furniture. Now, I'd like you to think about for a moment just which of these, if BI were to invest or make one investment, which of these would likely to be most impactful? Now, if I had more time, I'd love to take a poll and find out what people think and why. But perhaps a better question to that than that would be to take a step backwards and actually ask ourselves, can we tell, based on the size of a firm, whether an investment in it is likely to be more impactful if it is micro, small, medium, or large? Now, in the paper, we explain that at BI, we don't necessarily see firm size as a reliable indicator of impact. And the reason that I'm explaining this to you is because firm size, like when we, the relationship between size and impact is not straightforward. And that means that we really need to think about, when we're targeting firms of any size, we need to think carefully about how we go about it. Next slide, please. So as Tim already mentioned, SMEs matter, and they matter to the biggest global development challenges. And our mission here at BI is to help solve these challenges. So Tim mentioned SMEs significantly outnumber large firms. They account for more jobs, and they are also a drag on productivity growth. So taking this first global development challenge around the imbalance between small and larger firms. What we have here are 3 countries, Tanzania, Ghana, and Malawi, and you can see, particularly if you add in micro firms, so micro, small, and medium enterprises here, you can see the sheer imbalance between the number of firms of different size within these economies. And now part of the reason why DFIs target these smaller firms and try and help them to grow is that even having a slight impact at the margin can really change things. Next slide, please. As you can see here, if in Tanzania and in Malawi, just 1 in every 50,000 MSMEs were to grow to become large, it would double the number of large firms in those economies. And the same applies for 1 in every 20,000 in Ghana. So even just transforming a handful, the growth potential of a handful of SMEs can have a serious impact. Next slide, please. So I'm now going to turn to jobs, and you may be wondering how I could possibly link ducks, icebergs, and SME jobs. You have to bear with me, but essentially labour markets are a bit like ducks in that the real action happening in the labour markets happens under the surface. What I mean by that is above the surface you have headline labour market indicators like unemployment rate, employment rate, participation rate, and so on. But the real action, as I say, happens under the surface. It's the movement of people into jobs, movement of people out of jobs, movement of people from job to job. And in a similar way, labour markets are like icebergs in that we only see that unemployment rate is just the tip, and the vast majority of that action happens underneath. And this matters for, particularly in emerging economies, because this labour market churn is happening at more frantic pace than in richer economies. And indeed, it matters for SMEs because, as Tim mentioned, SMEs account for not just a huge share of job creation, but also of job destruction. Now, job destruction sounds like a bad thing, but it can actually be a good thing if bad jobs are being destroyed and good jobs are being created. And what I mean by that is bad jobs means low productivity, poor pay, and bad working conditions. So when BI or other DFIs invest in order to support SME growth, what we want to see is the creation of these good jobs and the destruction of the bad ones. Next slide, please. So often when we think of SME finance, we think of it in terms of this finance gap. And you may have seen the figures from IFC. It amounts, Maria mentioned earlier, this gap amounts to in the trillions of dollars. Now, the gap is calculated as the difference between supply and demand. So the answer to this might seem simple: let's just increase the supply and close this gap. But it's actually also the nature of that supply that really matters. Because if the nature of the finance being offered is not well suited to the nature of the demand for finance, then increasing the supply is not going to close the finance gap. And so what is it that SME owners actually want? Well, you know, we know from the evidence, but equally from our conversations that we have and engagement that we have with SME owners, this is just a list of a few things that seem to be really important for them. So flexibility around repayment, longer term loans are much needed. Less reliance on collateral as a means for lenders to manage their risk. Timeliness, they don't want long drawn-out processes. Equally, business support. So it's not just about financial support. Where you have a small family-run firm, sometimes they require support in order to reach that next level of growth beyond just the finance that's provided. And finally, pricing of the loan. So interest rate is of course important, but interestingly, we have found that it's not necessarily cheapest equals best. So it's not necessarily the lowest interest rate is the most attractive loan, because on occasion, SME owners are actually willing to pay higher interest rates for some of these other features where they see them as valuable. Next slide, please. So now turning to the lender side, you know, at a very fundamental level, SME financing is difficult to do, and a major reason for this is information. Now, in order to be a successful lender, you need to have the capacity to separate good borrowers from bad borrowers. That is absolutely fundamental. But where information is lacking, and particularly in emerging economies, it's difficult to ascertain the difference between good and bad borrowers, and even more so for smaller firms that don't necessarily have a proven track record. And this is ultimately a risk to the lender. So lenders have to take account of this risk when they go about lending. And the options to do this, they can price this risk into the interest rate and raise the interest rate, but that has its limitations, as does relying on collateral. You can charge really high levels of collateral, but this particularly boxes out certain groups like women and other marginalized groups who don't have access to collateral or don't have access to the right types of collateral. Unfortunately, a sort of another option is just to not to lend to SMEs altogether. And what we see in this chart here is, so this is African banks' exposure to sovereign debt. It is the red line over the last decade or so, and you actually see it increasing while private sector lending, the yellow line, is decreasing. And that's ultimately a signal that banks have this option of parking their capital in sovereign bonds and thus not lending to the real economy and particularly to SMEs. Next slide, please. And just recapping on this, SME lending is a risky business. The vast majority, and again, our paper focuses on Africa, so I'm speaking of Africa here, but vast majority of African banks report SMEs as a high business priority. But African banks typically face higher levels of default than banks in other regions. And then when you zoom in on the SME portfolio specifically, the risk is even greater. Now, the reason that I'm explaining this, and I think the one key thing I'd like you to take away from this talk today, is that the things that SME owners don't like about the terms on which they can borrow are often the things that lenders use to manage their risk. So the things that they don't like collateral, are just steps that lenders take to manage their risk. And obviously managing risk is important. So it really drives this wedge between what borrowers want and what lenders are willing to provide. And we see it as an important role that BII plays and other DFIs in finding out ways to overcome this wedge. Next slide, please. And this is my last slide, just very, very briefly, but there are different tools that we have and ways of doing this. One way in which we do it is work with established lenders, like banks, for example, to help them get more comfortable with the risk associated with SMEs. And we have different tools to do this, such as directed lending and risk sharing and guarantees. But besides working with established lenders, we also back innovative entrants into the market that can help bridge information gaps and overcome other barriers to SME finance in other ways, often leveraging technology, so such as fintech firms and digital banking and so on, in order to drive SME finance. There is also a third way in which that we back new platforms as well, where we spy a gap in the market, but I'm not going to talk about that because I think it's much more interesting to come from Jacob in a moment when he talks about Growth Investment Partners Ghana. So I'll end there. Thank you very much.
Right, thanks very much, Stephen, Tim, and Maria. I'm Jonathan Leap. I'm the Executive Director of the International Growth Center. And it's a privilege to be co-hosting with BII this event. As you will have picked up, BII first approached us about the paper that Tim presented. But we also have now quite a long-standing partnership with BII in co-hosting the annual DFI Fragility Forum, which we co-host with IFC, BII, and AFDB. And that's held usually in the spring, this year in the beginning of June. And really the idea is to try to, excuse me, as we are today, bring together research and policy thinkers to try to drive better policy and explore innovative solutions in different spaces. So in that case, of course, around pioneer markets and the role of DFIs in supporting that. In this case, very much around the important area of MSME policy. For those of you who are new to IGC, let me just say 2 words of introduction. We're a global applied research center, which is based in 10 countries across Africa, South Asia, and the Middle East, and supported by a hub at the London School of Economics. We were established in 2008 in partnership with Oxford, and we bring together 2 pillars. One is a network of leading academic researchers from around the world, so not just our own, LSE or Oxford, but the other is a set of country offices in Africa, in South Asia, and in the Middle East most of whom have been on the ground there for more than 15 years. And the virtue of that is that that enables us to understand deeply, to build strong relationships with local stakeholders, policymakers primarily, but also stakeholders across the economy, and then to do truly demand-driven academic research. So providing our policy partners and other stakeholders with access to the best quality research, but also providing top researchers with the opportunity to work on stuff that matters, to work on important questions in developing countries, our focus being particularly on low-income developing countries where we think we can play the biggest role in sort of adding value. So that's IGC. Really delighted to be part of this, this panel. And just briefly about the structure, we're going to have start with a panel discussion and then open up to questions for all of you, from all of you. So please do be thinking about questions you want to raise. We'll also be taking questions from our online audience. The event's being live streamed. So let me first, you've heard from our three speakers who are here with us, and you know that Stephen's an economist here at BII. Tim is our research director at the International Growth Center, and Maria is the chief impact officer here at BII. Very privileged to have joining us two very distinguished practitioners joining us from India and from Africa. Let me first introduce Hardika Shah. She's the CEO and founder of Kinara Capital. If you don't know about them, you should. It's an extremely impressive organization she founded in 2011, really at a front runner in the fintech space, and addressing several of the problems that Stephen identified in lending to SMEs, the problems of collateral, the problems of flexibility, the problems of speed. That she pioneered approach which used what we now call artificial intelligence, machine learning, to use big data to drive credit decision making. So it could be both fast and free of collateral. So the idea is that they deliver collateral-free, quick, flexible loans. And the portfolio now, I think, has delivered loans to some 40,000 businesses, and I think it's maybe $300 million total. There, both the firm and Hardika herself have been recognized internationally for the innovative nature of the work. We're also extremely pleased to have Jacob joining us. Jacob is the CEO of the Growth Investment Partners in Ghana, which, as Stephen alluded to, is a new initiative. And Jacob brings to that a really rich set of experiences in the financial sector in Ghana. He's a leader in the financial sector, particularly the investment sector. I understand that he has been involved either directly or indirectly in the allocation of some $1.7 billion of credit and investment to firms. So very experienced and brings a very welcome perspective. So welcome, Hardika and Jacob, welcome. And I'm going to start with questions to them, and then I'll come to the panel here. So first, Hardika, I wonder if you could, just tell us a little bit about the origin story of Hardika Capital and the decision to focus on MSMEs.
Well, thank you so much for that introduction, and thank you for having me at this panel at BII. So let me just level set. I know we saw a lot of stats about sub-Saharan Africa, et cetera, and generally around Asia, but specifically about India. India today hosts the second largest MSME ecosystem, micro, small, medium enterprise in the world after China. And micro, small, medium enterprises, MSMEs, are the second largest employer in India, the first one being the government services. And this distributed segment hires about 120 or employs about 120 million people. And there are 70 million such small businesses or micro enterprises in India that are essentially such a good driver. There was a question about, where do they fit in the economic, in the economy. And in India, for example, they contribute 30% of the national GDP. And then India's GDP is growing at about 6.5%, 7%. So that number in volume keeps increasing. So when you look at that set of people that are really just the economic engine, the biggest problem and the biggest gap is the credit gap. And that gap is $400 billion IFC has estimated that. So this is a number that is verified by many. And that, if you think about the challenge, it's such a big challenge to go after. So the origin story is actually very simple. This was the work that that motivated me. I felt like microfinance was doing a great job at the bottom of the pyramid. But when you look at the missing middle, this segment of small business entrepreneurs, and in India, when you think about it, while there are 70 million MSMEs, 90% of them are micro enterprises. So that's really the need of the hour to do something. And most of the solutions, as we heard by the speakers before, it's all around collateral based and or in a very complicated process, which most micro enterprises are more informal. They do not have the collateral. 2/3 of India doesn't own land or property that is mortgageable. So that was the problem that motivated me to start Kinara Capital. My mom used to be a small business entrepreneur, so I have that from my childhood, remembering how hard it was for her to grow and move her business. And so when the opportunity came to do something about it, here I am since 13 years building Kinara. And to maybe explain what exactly we do, I mean, our mission is to transform lives, livelihoods, and local economies. And as you said, by providing fast, flexible, unsecured business loans. And we have done, and I know you mentioned 40,000, but we are so quick. We've actually done 120,000 loans already since you spoke. So there's a lot that has happened in this space. We provide these loans to small businesses in manufacturing, in trading, in services. We operate in a mixed model with a branch network. So there is last mile distribution of services, interface with the customer, a personalization in local vernacular language. And at the same time, our entire process is AI ML driven. And we are able to turn around from the first hello to money in the bank in 24 hours. And that's such a value add to the small business owner who might have an order in hand and needs to know if he'll have money to take that order or not and grow his business. So that's what Kinara does. And we've been at it, and we are book size of about 400 million. We've disbursed over 800 million in the last 11 years. And we continue to want and do more in this space. So I'll take a pause here and hand it back to you.
Thanks very much, Hartika. Let me ask you a follow-up question with sort of two parts. I wonder if you could say, what about your model you think is most transferable? So we have many interested people here with us, both physically and online. So what are the elements that you've identified and developed now do you think are most transferable and sort of lessons, broad lessons? And the other, just a quick word about what you think of as your principal impact. So you talked about the different dimensions, and I wonder if you could just say something about that.
Yeah, so from a transferable point of view, since we've spent the last more than a decade really understanding how small businesses operate, to me, small businesses worldwide have the same personas essentially, and how to understand them, how can we assess them, the willingness to pay and the ability to pay. These are all very transferable. The data inputs might be different based on geo, country, and local, local adaptation of it, but largely the underlying principles remain the same. And so our model, we have been profitable for 9 out of the 13 years we've been operating. So our model, we know how to run it or drive it profitably. And so we can easily take those elements and go to another geo and look at and help others think of how to adapt their data into this model and how to build a unit level model that is scalable and also over time sustainable. Now, in terms of impact, we have created over 100. Yeah.
Oh, sorry, I'm not. Yeah, just sorry. Just before you get to impact, could you just say very quickly what are the key data that you use?
So there are actually 120 variables, and in our data decision model. But if I were to drive some of the top, sort of the high feature from a feature engineering perspective, the ones that really matter. which is around the capacity to pay. So which is all about the cash flow of the business, right? Understanding the revenues, understanding their personal obligations. Most of our customers are sole proprietors. So there's a little bit of fungibility between capital from the business going into paying school fees when school fees are due, etc. So understanding the personal obligations or that the proprietor has, as well as the business payments or business obligations, looking at essentially the cash flow of the business. That's a big element of our model. Also, various different elements that go into assessing the, for lack of a better word, the willingness to pay, the character of the person that allows us to, assess. Now, credit bureaus have become really prevalent in India, so we do get a lot of good data there, but there are also other ways to assess that. So that is another element that goes in. So basically business data, willingness to pay data, proxy or real from credit bureaus, and a variety of things around the sector, subsector, and local geo that we have amassed by doing business in those areas that can be easily configured for other areas or other geos, all go into making this model work.
Okay. Let me move on to Jacob, and then we'll come back to the impact question a bit later. Yeah. So, Jacob, you're really one of the sort of pioneers now in this new model that's being explored with BII's support. And I'd be very interested if you could just tell us about the concept and then also how you see it as contributing to a space that you know well in Ghana in terms of the growth of SMEs in the local economy.
Thank you, Jonathan, and thank you to BI for having me on this webinar. The journey of GIP started a little over 4 years ago when we approached BI for funding for an SME fund. But BI at the time has been thinking through the whole SME fund investment, given the rich history and the mixed results that it had over the period. The opportunity is there, but the results have not been great. And so the marching orders we had was, can you come back with some thought process around how we can approach this differently? The statistics have been given. SMEs form the backbone of the economy, contributing to GDP, I think in Ghana, close to 80% in terms of GDP growth, employment 70 to 80%. But they are faced with challenges, and SME managers have not been successful. And so we sort of worked through COVID, interacting with various stakeholders, the business community, just to understand what the pain points are. And essentially, the model of GIP is designed and tailored to address the pain points or these pain points, and then also to fill a gap that exists in the financing space. So essentially, our mission as GIP is to deploy sustainable, long-term patient capital to SMEs in an innovative way, using innovative products. And this is seeking to address some of the key challenges around dilution, because a lot of the businesses we encounter are family-owned businesses. They need money. They're not willing to give up equity stakes. There's a haggle over valuation. How do you exit if you invest in this businesses? Then there's the issue of currency as well. And so GIP is providing local currency financing instruments, which is a big innovation in the marketplace. And as I said, we're looking at long-term, and long-term here, our instruments have a 10-year tenor. And so depending on the needs and requirements of the business, you can go all the way to 10 years. Obviously, we are mindful. If you don't need 10 years, we don't give 10 years because, as Hadika said, money is fungible. They find uses for it. And we have to help them not to do that. I think another feature is the fact that our instruments are self-liquidation. liquidating, and therefore there's no conversation or huge discussion around how do you exit from these investments. So we invest and look at the cash flows of these businesses. That's what we invest in, essentially. We have flexible payment terms because flexibility is key, is critical. And in designing the products, various focus group workshops with the business communities were organized, put together, and we understood directly from them. Some of them have cyclicality in their businesses, some just by the nature of the industry they operate in. And so we needed to structure repayment terms that speaks to this cyclicality, longer moratorium periods. Unfortunately, we still take collateral. We're not yet at the stage where we invest collateral free. But lower collateral requirements from what the banks ordinarily would provide. And we understand that because we're also taking a risk in the business. And local currency, very, very key. Not only do we provide funding, but we commit to provide business support services or to arrange the provision of these business support services to these businesses, because essentially they need, in most cases, they need more than money to be able to grow and expand. And so we've targeted the areas of financial management, which is fundamental, and it cuts across all industries, environment and social and governance as the core business support areas that we provide. Obviously, our cost model is sensitive, and so we cannot insource the entire requirement. So we work with stakeholders within the industry to provide these services. And because we are offering volumes, we're able to sort of push down the price of these services to the investees. I think it's important to sort of talk about our SME criteria, because SME means different things to different people. And we've been very broad just to ensure that we cover a wide spectrum. So GIP is sector agnostic, of course, subject to BII's exclusion list and excluded activities. But businesses with turnover of between $500,000, so it's equivalent in local currency, up to $15 million. Same numbers or figures for assets, total assets, and full-time employees of up to 300. So any business meeting any two out of these three criteria qualifies as SME for GIP purposes. And I must also highlight the fact that we focus on growth, provision of growth capital. So this clearly excludes startup capital and early stage. And it's a deliberate choice because it's a new model and we have to give it a fair chance of succeeding. And so that is the space or spectrum we are covering. We believe that with time, once we have demonstrated the success of that model, other products can be layered on.
Great. Thank you very much, Jacob. Let me turn to Maria now, and I wonder if you could just tell us a little bit of what prompted BII to focus on SMEs and how it fits in BII's impact objectives.
Yeah. I mean, we, being the UK Development Finance Institution, we've been investing in SMEs really since our origination. So I think I was trying to do the homework, but I'd say at least 70 years we've been investing in SMEs in our markets in some way, shape, or form. In current day, it's still a big part of what we do. So we operate in a 5-year strategic framework, which started in 2022. And within that, we look to invest in productive, sustainable, and inclusive businesses. And the productive component of that is very needs-driven. And we see financing for MSMEs is the highest need we see across our portfolio in our market. So it's very much core to what we do. And today makes up about 20%, or I should say SMEs touch about 20% of our portfolio in our current strategy. Now, we also have tried, I mean, Stephen gave a bit of an overview of this in his paper. We've done this in lots of ways over the years. You know, we've on one end of the spectrum, we've invested in large commercial banks and, you know, just thought that they would do more lending on their own, which, you know, hasn't proven to be terribly successful because we've heard about the risks associated with that. So we've moved towards encouraging them with directed lending and other even impact-linked incentives on giving them rebates if they're lending more to certain targets. So we're still operating with that segment of the market, but we're trying to get a bit more sophisticated about how we might pull some levers. We've invested directly into financial intermediaries that are doing SME lendings like Canara, other microfinance institutions, et cetera. We've invested in SME funds. And, you know, we've learned lessons along the way, which if you haven't had a chance to read our paper, please do, because it gives a history of some of the things we've learned. But that really did lead us to also creating platforms and trying new things, which is how we came up with growth investment partners and what we're trying to do there.
Okay, great. Just digging into the sort of impact side, I wonder whether, you know, the metrics that you currently use enable you to distinguish the different impacts of different types of investments.
Yeah, I mean, for you know, sticking with the theme of SMEs, I guess everybody that knows this space knows it's a longer impact chain, and so therefore the evidence base is relatively weak, and getting data and quality data, credible data in our markets is difficult, and it's a challenge. So we're on a journey. We're getting better all the time, and I think especially when you look at SMEs, how we fragment it is certain types of SMEs we might be more interested in the SMEs themselves, so firm assets and revenues, et cetera, and then their employees. Some we might be interested in their customer base and their suppliers and the broader supply chain. And then there's, you know, several levels of data that we might need at every single one of those levels. So we do fragment it. We've been using different types of approaches to do the evaluations. I mean, we have sector evaluations that we do. We've been increasingly using surveys and proxies and working with a lot of suppliers that are out there in our markets to have targeted, you know, surveys that help us feed information to our broader portfolio. So I would say we're on a journey, but, you know, because we've been getting more granular in the data we've been collecting within our own portfolio, but also trying to share with the ecosystem, I think we're starting to build a better narrative.
Great, thanks. Tim, one of the things you didn't mention, sort of implied in talking about the sort of arc of development and those three important transitions from, you know, non-market work to market work and then into small firms and then to larger firms, is that each of those steps are associated with very significant increases in productivity on average. And that's part of what drives development. And of course, that continues right to the very top because increasing specialization and scale drives further and sometimes dramatic increases in productivity. So I wonder if you could tell us just a little bit about how we should think about that as the background in helping to inform and drive financing, how we think about financing for small firms.
Yeah, absolutely. I think that, as you've mentioned, the goal is to target the firms that have that high productivity potential, right? And I think the question is, what is constraining the productivity? Often that's maybe investments on the firm side, whether that's into new technologies or investments into their labor force, investments to managerial practices. And I think that's where the financing often comes in. I mean, the economists' answer on, you know, why there are constraints on financing, I think we've covered them pretty well. You know, it's maybe you're not accessing formal credit because you're kind of in the informal sector, in between both formal and informal economies. You might have collateral, but you might not have the ability to demonstrate that legally, that you have this collateral. Maybe the capital markets or the financial infrastructure just doesn't exist. So there might not even be a formal market that might be there. There's very limited banking services often. And then, as Stephen was mentioning, well, there's this mismatch between the demand of what the borrowers want and the suppliers and what they need, I guess, from their end. And so maybe if you can access that credit, that will give you the chance to make these productivity-enhancing investments, then maybe the tenor or the components of those credit packages are not attractive for you. So I think that's pretty well understood, and I think what I think is very interesting here, and this is maybe where the economist needs to end and the financiers need to come in, is that, I mean, we've, like, collateral is a notion that's been around for millennia. I mean, I think in different forms, right? And I think it's really great to see innovation in the finance space being able to not overcome the issue of a borrower, a lender needing to get a return on their loans, but finding ways to overcome some very rudimentary tools to ensure that. And so I think that's really a very exciting space. I think a lot more innovation here will allow these firms to enhance productivity over the life cycle.
Great. Stephen, we've talked a lot about the heterogeneity of SMEs and MSMEs, and particularly including micro enterprises in developing countries. I wonder if you could just say a little bit about how we need to think about tailoring financing to the needs of different types of enterprises.
Yeah, it's a really good question. I think the key to this is really segmenting the market in the right way, because as you said, there's so much different. You could have two SMEs in the same town, in the same sector, the owner's kids go to the same school, and yet they have completely different needs. So I think it's all about kind of segmenting it in the right way, and then choosing the segments of the market where the need is the greatest, and that's where we as DFIs should insert ourselves. And for example, we've alluded to, but not really talked too much about women-owned SMEs who face very different barriers to finance, and it's really kind of thinking in those terms, sort of the gender of the owners, equally the size, so the subgroups within that overarching group of SMEs, and the age of the firm as well. As Tim was saying, age has a real impact on sort of the rate of job creation and so on. And also, I think a key area that we need to think about as well is the sort of entrepreneurial mindset of the owner, I suppose, because we're mostly talking about growth capital here, but actually, when you see the surveys, SMEs are more likely to report a need for working capital than for growth capital. And so it shows that that not all SMEs, their first sort of priority is growth. Some prioritize stability and some want a bit of both. So you really need to think carefully about how you segment the market in that way, and then design your products accordingly. And I think one of the really cool things about Growth Investment Partners is that they've designed a sort of menu of products. So it's almost like rather than trying to design a different type of product for every single different firm, which would get very complex and time consuming and so on, you have a sort of menu which you can adapt to the firm's needs, but it's a really good way of sort of tailoring without sort of trying to design products to meet every individual firm's needs.
Okay, thanks, Stephen. Let me pick up on Stephen's point, Jacob, and come to you. So Stephen's talked about the sort of menu of options that you're developing. I wonder if you could give us your judgment so far as what parts of those menus, of that menu, is proving to be most important, or do you think most significant in filling previous gaps? So what are you doing, what's on that menu that's different from what else is already happening in the space? He's on mute.
Yeah, sorry about that. Apologies. I was on mute. Can you hear me now?
Yep.
Right, thanks. So, I mean, in terms of what are we doing and its impact filling the menu, I think tenor is definitely one. Averagely, businesses get funding from banks for up to 3 years. In exceptional cases, they go up to 5. And our average is actually 5 years. So that tenor is very critical for these businesses. And that is part of what GIP is providing. The flexibility is yet another, which is also critical, and that allows them to repay based on the cash flow cycles of their businesses. For instance, if you invest in a water business, the season for it is when the weather is hot, so they tend to sell more and get more cash. Where you have a school which qualifies. I mean, I know there are some restrictions about investing in education, but I just wanted to use that as an example where a lot of the cash flows will come in at the beginning of the academic year. And so in structuring a facility for a school, for instance, you have to take into account this fact. What some of the businesses find very useful, helpful, and it came up during the focus group interaction, is the provision of business support services, because some of them actually need that to be able to grow in the areas of financial management, and they begin to see that. I mean, we're evaluating a transaction, a company that sort of produces hygienic products for female clients. And through the Ghana Investment Support Program, which is a TA scheme that BI has launched in Ghana, we had an expert in last mile visit the company, and that actually gave us an advantage over other banks that they were talking to. And even though our pricing comes in slightly above what the banks is offering, they recognize that need from the outset. Then, of course, local currency, it's fundamental. So I think a lot of the issues which Stephen highlighted, the repayment structure, the tenor, the business support, are all areas that GIP is providing and filling the market.
Great, thanks very much. Hardika, I wonder if I could come to you next. We know that there's, and Stephen briefly alluded to it, we know there's a pronounced gender financing gap for businesses. We've recently been doing some work in the venture capital space, and there's been a huge gap in the level of funding going to all male versus mixed or all female startup teams. And we did a project with Village Capital, which showed that if they introduced a formal data-driven evaluation process, the gender gap disappeared. So I wonder whether, so that's a hopeful message. Now, I know you're part of a women-led business, and women, I think, mostly managed business. You've also been part of another initiative, I think, Hardika, which has been in this space. I wonder if you could tell us, maybe starting first with Kanara, but then right there, what do you think the key challenges are, and at least some of the key elements of solutions?
Yeah, so thank you for that question. I think it's a very important one, and seeing this from both sides as a female founder trying to raise VC capital at all times to grow the business. Thirdly, would love to know more of what you've discovered, felt it, would love to know more in data and statistics. And the same challenge that I felt as going out to raise capital, I see that in our entrepreneurs and our small business owners. And I want to, Jacob, thank you so much for bringing up, the level set of what is a small business owner. So maybe I'll just do that in the Indian context. Here, it's less than $500,000 of average revenue for the year. And on average, a small business owner employs maybe 7 to 10 people. Now, when I look at the 70 million small businesses or MSMEs in India, only about 10 or 12% are actually women-owned and operated, when that is not the ratio of people in the country. And what we discovered when we went out and met these women-owned operated businesses is the challenges they had was around gender bias. So one immediate thing, of course, by not taking collateral, by being, unsecured business loan, we are breaking one part of that problem, because women most often actually do not own the collateral. Even if there was any collateral to be offered, it usually is in the name of the man of the house and not her. So that's one way to reset. The second thing is our AI ML model, which is, gender neutral. It doesn't understand male or female, and therefore decision that happens is unbiased, and it's more appropriate for the business need and the type and solution that the business needs in terms of the loan. The Har Vikas program is our own program, and what it is essentially to promote women entrepreneurship. We do it at 2 levels. We give a discount to the loan itself, to the interest rate of the loan, for women that are already operating a business. And we have also launched a more startup version of that. It's for women who have something started. Often, most women start businesses from their home, but want to now formalize it and need capital, need that, sort of push to go out and make it more formal. We give a 6-month moratorium, essentially of interest-free period for the loan so that they can get going, get set up, and then they have the, the ability to pay on the back end of it. Now, we have done, well, this calendar year, we will actually have cross $100 million in cumulative disbursements to women-owned businesses. And they form close to about, 18 to 20% of our portfolio today, and as opposed to what is the national average. So we're very proud of this program. One other thing, and I'm going to weave the question you asked about the impact, because I think these are very important and related points. So while we have our impact is around, job sustainability, job creation, and overall across our portfolio, we have over 400,000 jobs that we have supported. The proprietor income that goes up is around 14%. But for women-owned businesses, that 14% goes to about 17 to 18%. So you see more income increase when they're a women-owned business. And the other thing that is the most important is that the women-owned businesses, the jobs they create, more than 1/3 of those jobs go to other women. So you have a lovely domino effect and a positive social impact by just supporting more women in business.
Great, thanks very much. Maria, I wonder if I could come to you next, slightly broadening the scope of the discussion. We know that one of the key drivers, a key driver of growth for SMEs is access to global value chains. Now, of course, more challenging in the small business space. We've been involved in some work in Rwanda and Uganda, developing supplier portals, which are sort of facilitating access to both information and matching. And then there's also been interest in aggregators. So India is one of the places we see them, Kenya as well. So these often online, but not necessarily mechanisms for aggregating small producers, enabling them then to sell to large producers. So I wonder if you could, and there are other ideas as well around this space, I wonder if you could tell us what BII is doing in that space and what you think are perhaps the most promising.
Yeah, I mean, we're seeing lots of different models coming up. We agree this is one of the biggest barriers for growth, certainly, right, is having access to these global value chains and supply chains. I mean, we've seen in our markets, we've seen very different in different segments, because I guess it depends very much on what sector you're operating in, what market you're operating in, what supply chain you're a part of. But I mean, some of the interesting investments or things we've seen are everything from in the fishery business, and we've got a business in India, which is taking local fishermen and SMEs and connecting them through technology and apps to international aggregators and distributors, actually across the chain. That's our investment in Captain Fresh that I'm thinking about. We also, I mean, some of our larger sort of B2B technology investments in marketplaces, it might not be their core business, but how they're starting to increase their exposure about how they take some of their customers and SMEs and link them to international suppliers. So, Bazongo is a good example of that. It's not their core business, but they're thinking increasingly about how they can expand. In the ag space in Africa, we're increasingly seeing more trading or aggregators that are trying to take smallholder farmers, particularly in cocoa, and thinking about how they can aggregate that and to distribute it. So we are seeing a variety of different models. We are trying to understand where we can play a role in that, but it is very important for the expansion of the SME sector.
Let me pick up on that idea of innovation, Stephen, and just come to you. We've already seen in Hardiga and of course with Jacob as well, the GIP, examples of innovation in this space. I wonder if you could just say a bit about, paint a slightly broader canvas for us. Where do you think are some of the more exciting innovations here in terms of delivery of finance to SMEs?
I mean, I think from both Hardiga and Jacob, we've heard some really interesting examples of innovations. I think probably some of the key areas of innovation really sit around not just thinking about the lenders themselves, but the digital infrastructure that is required for those lenders in order to operate. It's quite easy when we think about SME finance just to think of the people who are dispersing the money to the SMEs, but we also need to think of the sort of ecosystem that enables them to be innovative and do things in a slightly different way. I think also we need to think about scaling when it comes to, when we think about innovation, we need to think how to scale these sort of SME financing platforms. And a lot of the time when we think about mobilizing capital into these sorts of things, we think of international capital, but quite often it's local institutional capital that we need to think of in an innovative way how to mobilize them into these, because it's typically local currency that SMEs need. There are some exceptions, and it's very difficult, obviously, to mobilize, say, UK pension funds into SME finance in Africa just because of the currency risk. So I think we need to think of innovation in terms of the ability to scale and how to mobilize capital as well.
Great. I just want to cover two areas and then come out to all of you. So just a sort of warning, we'll be interested in coming to you for questions in just a few minutes. So the first of these topics is really about a bit of a forward look. So I'd like to come maybe Jacob first to you and then to Hardika. And if you can answer quite briefly in the outset, and we'll have a chance to bring other people in as well. What do you see as some of the key both challenges and opportunities over the next 5 to 10 years? So Jacob first.
Yeah, thanks, Jonathan. I mean, I think clearly the challenges have been outlined by previous speakers. This will continue to persist, and I think it's more of focusing on the opportunities. How can one sort of look at the terrain, the challenges, the difficulties, and come up with solutions and products through innovation to address that. So in terms of opportunities, I would expect to see longer tenured instruments sort of becoming the order of the day. Our macro environment is challenging, and we have cycles. You have periods of stability, and then it goes out of the window, and you need some time to correct. And it is only when you have longer tenured instruments, which by definition means that it has to be sitting within some long tenured structures, either funds or even permanent capital vehicles. So I would expect to see the likes of GIP being replicated in some shape or form by other investors. I think it would become the order of the day going forward. Local currency instruments, I mean, Stephen just alluded to that, the extent to which local capital can be mobilized. And if I take the case of Ghana, the pension industry has sort of been privatized to an extent where there are private fund managers and they are looking for good investment opportunities to invest their money in. They thought they had a safe haven by buying government paper. But what happened 2 years ago, government becoming broke and therefore not able to honor its obligations and seeking restructuring with deep haircuts has sort of jolted them into thinking and looking for alternative investments. So we will see local money sort of coming into the industry and therefore the SME space. And I think this is important, the extent to which there will be that collaboration between international capital and local capital, I think will be interesting. I think it's also worth mentioning that there isn't going to be a sort of a one-size-fits-all approach. It has to be unique, and there has to be some collaboration which would seek to introduce or bring together, market discipline, which would bring together local and private and public capital. We'll see intense lobbying of governments to create an enabling environment to attract investors in tax incentives. We in Ghana are benefiting from incentives under what is called the Venture Capital Trust scheme, where venture capital financing companies, and that is defined loosely, anybody engaged in SME financing benefits from some tax incentives. corporate income tax of 5% versus the regular tax of 25% for at least the first 10 years. There was
Let me cut you off here, just because I'm keen to both get something from Hardika and then to open up to the audience here in the room. Hardika, could I ask you a very narrow question about future opportunities? You were one of the pioneers in using machine learning and AI. Could you just briefly tell us what you think are some of the most exciting opportunities going forward, building on the latest iteration of large language models? I'm thinking of ChatGPT 4.0, and then the promise of 5 in the near future, and of course the corresponding Claude and so on. So could you just tell us what you think? Is this going to be transformative? Where do you think it will be most important?
Yeah, I mean, definitely, I would say that on the ChatGPT and the sort of the generative AI, the transformative part there is to bridge the gap. We heard a lot about digitization. India is on a very different digitization journey than perhaps other countries. And the small business owner, one of the benefits of that is we need to bring them along in this digital journey and get them more formal, more integrated. And where the opportunity, I think that that brings this together is embedded finance. If I can intercept the need of the small business owner where they're on one of these platforms where you're talking about where they're trading or needing to buy raw materials and be able to finance that at that point of need based on the transactions, based on their history, and based on the formalization of their business now, it could be very transformative to making sure the right capital with the right features, ends up in the right place at the right time. That's my quick short answer.
Okay. Thanks very much. I'd now like to open it up both to the audience in the room, but also the online audience. And maybe add just one little request. In light of our hosts, I would welcome questions on where BII can be doing more in this space.
Please.
Take first at the back. Sorry, do you want a mic? Yeah. So please wait for the mic so the online audience can share.
Hello. Is it on? Yeah.
Yes.
Good afternoon. My name is Peter Boonman. I'm from SMV, the Netherlands Development Organization. Okay. We work quite closely with the Dutch DFI FMO, this is in what you call the Dutch Fund for Climate and Development. So SNV is an international, it's an INGO, and WWF together do the origination for the deals that FMO and climate fund managers then invest in. So if you look at the different, you could say, dials in supply, demand, governance, etc., then this is a way of increasing the supply of deals, because a lot of investors, they always complain like there's no pipeline, and this is a way of unlocking pipeline. So in terms of what BII can improve, what is the idea of BII to unlock more pipeline?
Great. Sorry, let me take 3 questions and then we can film. So here, right in the front here, and then. Okay.
Thank you, Tom Sanderson from FCDO. First of all, big thank you for today's event. A question to Jacob, if I may. First of all, Jacob, I love your picture behind you. It really speaks of the early entrepreneurs. I was hoping you would say that the 5-year outlook is that banks, who are also permanent capital vehicles, would also transform their businesses and begin lending local currency, which they always do, to these entrepreneurs. Is that a demonstration effect that you are aiming for and BII is aiming for? And secondly, a quick one to Stephen. You flipped over a slide on NPLs, and the microfinance story was that the entrepreneurs in Jacob's pictures are uncreditworthy, but the truth was they were creditworthy. Is it the same with the SMEs? I think it looked like the SMEs had quite a big NPL compared to the large firms, but maybe pick up on that. Thanks.
Great. And then one more, this woman over here in the second row.
Good afternoon, and thank you for this panel. Shaima Ahmed, working on private sector development and impact investing in Sudan. My question is about actually emerging markets more that are more unstable, and not particularly Sudan because of the conflict now, but other countries in sub-Saharan Africa that are not your typical Ghana, Kenya, South Africa. What is BII's approach into supporting MSMEs in these markets? And also a question to Tim, if we have any evidence from such investments in these markets, and if we know that MSMEs are a potential for development and growth.
Great, thanks very much. I invite all the panelists to comment on any of the three questions, but Maria, let me start with you, since quite a few of those were pointed at BII.
I think at least 2 or 3 addressed to BI that I can start with. So pipeline, I guess the question is, like, pipeline for who? Again, it links a little bit to Tom's point, which is, so yes, I mean, a large reason why we help set up growth so partners is to think about how you help, think about origination and, I guess bridging SMEs to the financing need that they need, or to formal financial services. And so, through all of these interventions that I mentioned, whether that's working with banks to think about how they develop new products, or we risk share to take some of the risk off there, for supporting earlier stage business models, for setting up new platforms. I mean, all of that is to, I guess, build a pipeline towards SMEs of formal financing. But often the story is about making them bankable to bridge the two questions, right? So in a way, sometimes we're also trying to create a pipeline for the banks, or a pipeline for the more mature financial institutions, and that could be through the interventions that we discussed today. And we're also doing things in fintech where SMEs that need different types of working capital, especially in the technology sector. Banks don't understand how to analyze the cash flow and how to provide them with working capital. And so can we work with different types of specialty lenders to, again, bridge that gap and kind of build the pipeline for the formal institutions. Maybe I'll just take the one question while I'm here. I have the floor on the alpha. Our terminology, alpha markets, for the more frontier markets, let's say, within our geographies. I mean, we operate in Africa and South Asia, so and we are incentivized with how our impact framework is to go into the harder geographies. And SMEs are, as we've just talked about today, always the largest portion of businesses that we see in these markets. Now, obviously, we need to think about how we enter these countries from a risk-adjusted approach, and also just what's practical. So often, what we'll do in the more frontier markets is go through the formal institutions, and so we'll look for partners that are on the ground, whether that's the international banking platforms or the regional banks, and we'll think about. Oftentimes they're not lending to the real economy or to SMEs in these markets, but we'll try to think creatively about what we can do to encourage them to do so. So that could be, an example at the moment is we're looking at a very frontier market in Africa where we might provide a 1-year hard currency trade loan, so that and 100% of the use of proceeds will be going to SMEs that are importing trade. We might go through a large international African banking platform to risk share, to tell them we will take some of the risk if they go into SMEs in the markets that we think need it the most. And so, it's harder for us to do direct investments or set up platforms like growth investment partners in all of these markets, but we can work with partners in order to try to address the segment.
Stephen, do you want to take the question that was directly addressed to you? Then, I'll take Tim, the question on you, and then Jacob, I'll come to you about the question that Tom addressed to you.
Yes, sure. Sorry for skating over that slide, but essentially what the chart was showing was the share of banks with greater than 10% NPL ratio in their whole loan book versus their SMEs. And so, as you can see, there was a greater share of banks in their SME portfolio with that greater than 10% NPL share. And I think the reason, and like a bank would point to that and say, this is why we don't lend to SMEs. But I think the real issue is that SMEs, SMEs face different risks to larger businesses. and lenders aren't yet necessarily used to managing the types of risks that SMEs face. So I think that's the real issue that we see here, is that and that's partly what we do, as I mentioned in a later slide, the different tools that we use working with banks and other established lenders to help them get used to lending to this segment and managing those types of risks.
Right. And Jacob, if I could come to you, and briefly, if I can ask you just to respond to Tom's question about whether GIP can help push banks towards more lending.
Yeah, thanks, Jonathan. And Tom, thanks for the compliment on the picture. I can see banks getting involved in provision of alternative funding. As part of local fundraising, we spoke to a number of banks to test the appetite of investing in GIP. They do have some regulatory restrictions. And so I think the regulator, the influence and impact of the regulator on their ability to get involved in permanent capital institution is something that we need to watch out for. But I definitely believe, and I agree with you, in the next 5 years, we'll see a lot more banks coming up with products tailored to address SME needs. You can understand from the pressure they are coming under from the Central Bank of Ghana to increase their loan to deposit ratio. And to push them, they've come up with a dynamic ratio requirement where if your LDR is more than 55%, your cash reserve requirement with the central bank will be only 15%. If it's between 40 and 55, then that inches up to 20%. And if it's below 40, then that sort of goes up to 25%. So this will put pressure on banks to look to increase their lending. And I can see products being developed. You have supply chain financing. That could be a way that they could go. A lot of them are setting up SME desks dedicated to addressing that need. So I definitely see banks' involvement, not necessarily through a GIP type vehicle because of regulatory restrictions on their ability to invest equity in permanent capital institutions. What we can also see happening, and in the case of GIP, over the long term, you don't necessarily need to raise equity, but you can raise long-term debt. Once you have a strong underlying portfolio that is generating cash, on the back of that, you can raise long-term paper, 10, 15-year paper. We can see banks investing in such instruments.
Great. Thanks very much, Jacob. So let's take another round of questions, but I wanted first to check with Jane and Mamuna. Do we have a question from the online audience?
So I have one question from somebody in the US actually asking, US family offices, investors and high net worth individuals are interested in SME investment in emerging markets, but they don't know how to access the market. Where would they start? How do you connect? There is also another one around investment. One moment. Something around the role of incubators and accelerators and the role they can play in de-risking for lenders. And then, beyond capital, how do you overcome the financial literacy challenge across the different markets?
Okay. Hardika, let me come to you. Could you hear all those three questions?
Yes.
Okay. Let me come to you first just to comment on each of them briefly or more at length if you wish.
Well, on the first one, how do you get access to people who are doing this? I mean, I think there are many avenues. BII would be a great facilitator there, as are other DFIs. So I would put that back there for an answer. In terms of beyond capital, what can be done for small businesses? It really comes down to understanding the local markets. For example, we run a Grow with Kinara series, and this is to help our small businesses actually keep up with the trends, keep up with government programs that they can be part of, that can get them access to platforms where they can, basically get the market linkage for their products. And this goes a long way in supporting the small business from a growth and sustainability perspective, beyond capital. And the third question, I'm sorry, Mamuna, you'll have to. Middle question, I've now lost track of.
It was related. It was the role of incubators and accelerators.
Yeah, I think, see, there I would actually, and that was for de-risking, I would actually say that small businesses, at least the ones that are our customer base, I mean, they know far more about how to operate in that, local geo than perhaps an incubator could help them with. It has come from experience, it's come from learning on the ground, and they are, absolute amazing business operators. So I'm not sure incubator is a solution there, but certainly helping them with scale and digitization and modernization is required.
Great. Maria, anything you'd add in terms of these three questions, particularly, I suppose, about the US Family Office question, if they're looking to invest but don't know how?
Well, yeah, I mean, you can follow up with me directly, I think, and I can put you in touch with some of the funds that we have that would have share classes available to retail and institutional investors. It's Maria Smith. My email's on the website.
Okay, great. Let's take a final set of questions here in the room. Ooh, we're very short of time, so okay, there have to be very brief questions. So let me just go first. Here and then there, and I think we'll probably just be able to take those two and then have quick answers.
Good morning. My name is Jacques. I spent 50 years in Africa, now based in the UK. And the question is targeted at you, or why don't I say targeted to you? I need some guidance. As you know, in developing countries, specifically in Africa, women's got a major obstacle to access funding and finance, not only because of cultural, but a few other issues on the line as well. I currently took a major investment specifically to Africa. I'm not going to mention the country, but it's going to, with a global order book in excess of 50 million, and it's taken me more than 7 months to conclude it. I'm currently the economic advisor to Nigerian government as well, guiding them specifically on women empowerment and investment to SME. So I need to get some guidance from you that's done it. 120,000 transactions, congratulations, and well done to your mom making a super entrepreneur. So I need some guidance on the cultural, specifically in the developing countries. Thank you.
Okay. Yeah.
Maybe I'll just quickly there. This is such a deep and complex topic. Maybe we can take it offline. My email is hardika@kinaracapital.com, and we'd love to have a chat offline with you.
Great. Actually, it's very, very quick. You can, and then we'll wrap up.
Vince Ming from Minfo. One of the BII slides shows that the ratio of SME to the large firms are pretty high. So I presume the failure rate in the next 3 years also quite high as well. So what are the strategic framework to basically balance up the risks, the capital and the collateral in terms of the funding frameworks that you have? Just some sort of insights.
Okay. Who are you directing the question to?
I think maybe from Steve, Tim, or even.
Okay. So Steve, why don't you comment briefly and then we'll wrap.
Maria might be.
Oh, okay.
Sorry,
Maria?
Well, no, I think overall, so how are we at BII managing our portfolio in terms of those parameters, or how we think about it from an SME investing perspective? SMEs, yeah, because SMEs is a small, not a small portion, it's 20%, but it's a smaller portion of what we do. But it's the art. I guess it is the art of what we do. Is we're trying to balance risk, return, and that's our fire drill.
Okay. Well, let me quickly wrap then. A huge thanks to Hardika and
it's not an actual drill. Nobody has to get up.
A huge talk about a hard deadline.
Yeah.
A huge thanks to Hardika and Jacob for joining us remotely, and Stephen, Tim, and Maria here in the room, and thanks to all of you for coming.